What's going on, you guys? My name is Zach Hartley, and in this video I'm going to walk you through how to hedge your portfolio. Here is everything you need to know. Let's go. Okay, so first of all here, what is a hedge? Well, a hedge is an investment position that is intended to offset potential losses that may be incurred by a companion investment. So in this situation, the companion investment is your portfolio or your original investment or the shares that you currently hold. And what we are trying to do is learn how to hedge that portfolio or hedge those investments so that you reduce your risk. That is the goal of hedging. That is why people hedge. The entire goal is to reduce risk in the event that the portfolio or security declines in value. So for our example in this video, we are going to say that you have a $10,000 portfolio and it is invested into the S&P 500, but for whatever reason, you are concerned that the market is going to crash. You think we're going to see a pullback, the market's going to crash, we're overvalued, we're in a bubble, doesn't matter what the reason is, you think that the S&P 500 is going to decline. Now, in this scenario, you actually have a couple of different options. Number one, you can sell everything and just convert to cash and hold it, but unfortunately, inflation right now is pretty high, so a lot of people don't like that. Second option here is to do nothing. However, if the price declines, then you're just basically left holding the bag. Third option here is to average down. A lot of people call this dollar cost averaging or buying the dip, averaging down, whatever you want to call it. It's basically adding to your position that you're confident in when it declines in value. That is your third option here. And your fourth option that we are going to talk about and walk you through in this video is called hedging your portfolio. Now, how do you hedge your portfolio? Very simply, the idea here is that you want to buy a security that will increase in value when your securities decline. So in our example right now, we are holding the S&P 500 ETF. So we would want to buy a security that will increase in value when the S&P 500 declines. That is the idea here. And ideally, we want to buy a hedged position that has a different risk to reward ratio. So if we are holding stocks right now, we probably want to be buying options or derivatives or futures so that we can make a higher risk to return ratio in the event that that position declines. It also means that we have to invest very little amount of money compared to our own position. Let me walk you through what I mean by that. So number one here, in our example, we have that $10,000 portfolio in the S&P 500. In order to hedge this portfolio, we would buy SPY put options. Now the reason we would do that here is because if the price declines, our portfolio will lose value, but our SPY put options will increase in value. The reason they will increase in value is because put options allow you to sell shares at a specific price known as the strike price on a specific day that is known as your expiration price. And so if we buy put options in the S&P 500 ETF, also known as SPY, to let's say sell at $200 and the price declines to $150, that means that our options give us the ability to go into the market at $150 and buy those shares, and we have the right to sell them at $200, making us that $50 profit. That is the idea with how put options work, and that is how we would make money in the event that the S&P declines in value. Now, if you want to learn more about put options and how they work and how to use them, I have a full video that walks you through the entire step-by-step process. I will link it in the description to this video. You can also find it on my YouTube channel. But basically, what we are trying to do here is we are trying to buy the other side of that trade. So if we hold Apple shares, we would want to buy Apple puts. If we hold a lot of technology companies like what's in the NASDAQ, we might want to buy NASDAQ puts, or we might want to buy a leveraged inverse ETF. There's a variety of different options that you can use, but basically what we are trying to do is we're trying to have our main portfolio that was our original investment, and we're trying to take a new investment on that has a higher risk to return ratio that will go in the opposite direction, so that if our portfolio declines, hopefully those hedged positions, those options that we bought, will increase in value dramatically and offset that loss from our portfolio, overall reducing our risk. Now, a couple of things to consider when it comes to options. Number one, options are riskier than stocks. They have a higher risk to return ratio, so you really need to factor that in and you need to be aware of that. If you want to learn more about how to use options, check out the links in the description to this video. Secondly, hedges are usually temporary and they have an expiration, especially if you're using options. You can buy these options that expire at whatever date, but the further out you go, the more expensive they usually become. So you have to keep that in mind. Most of these hedges usually come with a time frame associated with them. And also on top of that, hedging usually has commissions and will cost money to execute. So for instance, you're gonna have to pay to take on that new position depending on what brokerage you have. And then if the hedge isn't needed, so let's say that the S&P 500 does not decline, the value of that hedge will decline and you will lose money on that hedge. So if you hedge your position and ultimately it's not needed, you will more than likely lose money on that hedge. And so it is a risk mitigation strategy, but if that risk doesn't come to fruition, it will cost you money. But if the risk does come to fruition, it will save you a lot of money. So it's kind of like buying an insurance policy for your portfolio or for whatever you're holding. Now, if you're interested in learning more about any of this, I have a bunch of courses on Skillshare. That is where I post all of my content. I have courses on options, on stock market fundamentals, and on personal finance there. And you get 1 month completely free when you use the link in the description to this video. I have over 21,000 students, over 600 reviews on my courses, and just coming up on 2.6 million minutes of watch time all my content. So I highly recommend checking it out. I promise you it'll be well worth the time. It's completely free for the first month and the link is in the description to this video. Thank you so much for watching this video. I sincerely appreciate it. If you got any value out of it, please remember to click that like and subscribe button and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.